this morning?
Yes, and I just got it started.
Perfect. All right, good timing. So, good morning, everyone. I know several of us have met previously with the last RAC meeting in August. I think it was August, maybe it was even the beginning of this month. September's flying by. I do still want to do a quick round of introductions, just looking at the participants this morning. Looks like we have some folks that are joining us here. So just if we can do a quick round of introductions, and I'll lead things off. So my name is Brian Peltheim. I'm a senior policy here with the Division of Financial Regulation at DCBS. And I'm leading the rulemaking effort around Senate Bill 829 as far as new rule language to provide a premium assistance program for affordable housing, shelter sites, project turnkey, and navigators. And I'm sorry, I think I hear someone talking. Was there a question? Or if not, maybe go ahead and mute your microphone. Okay, not seeing anything or hear anything. So yeah, just welcome to the Rulemaking Advisory Committee, or RAC for short. And sorry, my apologies, just looking at the agenda, I already see something I missed. This is actually the second RAC meeting, not the first. So I missed that on the agenda. But I think I'll go ahead and hand it off then to staff here. I know we have some folks from Housing Community Services, and then we'll just kind of go around the horn. So I'll just go ahead and start off here with staff. And I know, Karen, if you can just introduce yourself.
Yes. Hi, I am Karen Winkle, the rules coordinator for the division on the policy team.
Great. Thanks, Karen. And Hunter.
Yeah. Hi, I'm Hunter McClure. I'm the policy project manager and just helping moving things along.
Great. Thanks, Hunter. Appreciate it. And then I see Eric Cutler.
Good morning, Eric Cutler, Senior Advisor on Property and Casualty Issues.
And John Hayworth.
Morning, everyone. My name's John Hayworth. I'm the Insurance Licensing and Retaliatory Tax Manager.
Great. Thanks, John. And Jesse, I think you're on.
Yeah, good morning, everyone. I'm Jesse O'Brien. I'm the Policy Manager with the division.
Great. Thanks, Jesse. Appreciate it. And then for HCS, just because I see you on camera first, Tanisha, do you want to introduce yourself and members from your staff?
Yeah, happy to. Tanisha Rosas, Senior Government Relations Strategist at OHCS, and I will pass it on to Patricia.
Hey all, good morning. My name is Patricia Akers. I use she, her pronouns. I'm an operations and policy analyst in affordable rental housing at OHCS, and I'll pass it on over to Danielle.
Hi, good morning, everyone. My name is Danielle Bautista-Silton, use she, her pronouns, and I'm an unhoused policy and planning analyst with the Housing Stabilization Division, primarily supporting shelters. And I don't see anyone else from OHCS.
Thank you. Appreciate it. And then I'll just kind of go down the list I have as far as I see folks in teams. So this is in no apparent order. I'm not picking on anyone by going first here. Melissa Bishop. And Melissa, if you're talking, I think you're on mute. Okay, moving on. Karen Thessing.
Good morning, everyone. Karen Thessing, Executive Director for two pools. One is HARP, the Housing Authority Risk Retention Pool, which is created by public entity housing authorities. And the next one is the Affordable Affordable Housing Risk Retention Pool, known as AHARP, and that is a combination of nonprofits or other entities receiving tax credits for affordable housing. Thank you.
Thank you. And Ed. It looks like you're still on mute there.
There I am. Okay. Ed Davis, I'm the legislative chair for the Independent Insurance Agents and Brokers of Oregon, Big I, Oregon, and I'm with MAPS Insurance Services, and basically just trying to see from an insurance standpoint what we can offer in terms of hoping everything makes sense.
Great, thanks, I appreciate it. All right, and then is it Shira?
Shira. I am Shira. I'm the executive director for Classic Behavioral Healthcare in Classic County.
Great, thank you. And Marcy.
Good morning, Marcy Cartagena, she, her pronouns. I'm with our.
Thank you. And Montana?
Hi, everyone. Montana Llewellyn. I am sitting in for Kenton Brine with the Northwest Insurance Council.
Great, thank you. And Michelle?
Good morning. Whoops. I'm Michelle. So I'm the executive director of the Oregon Consumer League.
Great, thanks. And Danielle?
Hi there, Denny Ritter. I am with the American Property Casualty Insurance Association.
And Denny, my apologies. I knew that, and as soon as I said, like, well, that's wrong, but I tried.
Oh, Brian, don't worry. I answered Jenny, Penny, any variation therein.
Thanks for being a good sport. I appreciate it. And Peter?
Hi, everyone. I'm Peter Beyer. I'm the Chief Financial Officer for Central City Concern, a healthcare, housing, and employment services provider in the Portland region.
Thank you. And it looks like we have another Brian on the call. Brian who? And Brian, looks like your microphone might be muted. I can't hear you. Well, hopefully Brian can get his microphone fixed here. I understand the frustration around that. And it looks like Natalie.
Hi everyone, my name is Natalie Thornton. I'm a senior asset management project manager with Housing Development Center. We're a nonprofit consulting group, and I work with a number of nonprofits that are facing insurance challenges and properties at risk of foreclosure. So hoping I can add that perspective to this conversation.
Great, welcome. And then Tyra.
Hi, this is Tyra Dressel. I'm the executive director of Big Eye, Oregon. Thank you for having me.
Morning. And looks like Smita.
Hi, everyone. Sorry for joining late. I'm guessing we're doing introductions. Swetha Bhatti, she, her pronouns, Senior Housing Advisor in the Governor's Office.
Morning. And then it looks like we had a couple folks hop on here. Just want to make sure I'm able to get them as well. So let me make sure I can see who that is. Looks like John Powell.
Good morning, John Powell, representing State Farm.
Morning. And just double check here, make sure if I miss anything. And then, okay, great. It looks like Melissa was able to join. And Brian, sorry for the issues with the microphone here. And folks, if you're having any difficulties with microphone, please feel free to add comments to the chat. Either myself or Karen will be monitoring there. I recognize from personal experience recently that sometimes our tech doesn't always work the way we hope it will. So we'll do our best to kind of work through that. And also too, if anyone is having any microphone or issues there, there was also dial-in information. So if Teams on your laptop or tablet is not working, please feel free to also dial in too. We can get you squared away there too. So Karen will kind of be manning the screens here today. I appreciate her doing that for me. We have just the agenda up here this morning. So pretty much the major thrust of today's RAC meeting here is to discuss what I see as the primary or major topics as far as for this rulemaking. I did my best to kind of summarize them here in the agenda. But there was also a draft document that was circulated to folks the other day along with the agenda, and it was kind of some, I wouldn't call it boilerplate, I would call it kind of like framework language for the proposed rulemaking. We'll pull that up here in just a sec, but on these points here, these were kind of discussed at some length during the last RAC meeting. So my takeaways from that discussion, and as we see it here at DFR, some of the main points for this rulemaking. I created this draft language, and this is not fully. This is not what the language is necessarily going to look like. But sometimes it's easier to have a point of discussion if we kind of have at least something kind of ink on paper to look at collectively and have some opportunity to digest that. So what I want to try to avoid doing is a lot of like group wordsmithing to the language here. I think it would be more helpful if I can get folks kind of perspective. If you have comments or insights that you can provide around this. So I think that's kind of a good way to introduce things here. And I saw a couple other folks joined here late in the call, so just letting folks kind of know where we're at. So we just completed introductions for folks today on the call. Just kind of going through today's agenda, and the document that's on everyone's screen here is example or draft rule language, or what I'm referring to as kind of framework language that was put out for folks to kind of digest how DFR is looking at this program and what we're looking to try to achieve. And without putting her on the spot, as far as Sveitha, I just wanted to see, I know you're on the call today. Did you have anything you would like to add to the discussion before we kind of dive in?
Thanks, Brian. No, nothing from me. I'm happy to be here and looking forward to hearing the conversation.
Okay, great, thanks. Alrighty, so and for folks who did not have a chance to join us the first time around, I'll just kind of go give you a little bit of a snapshot of what we're talking about here. So in this most recent legislative session, the 25 session, Senate Bill 829 passed. It is a kind of a multifaceted bill that's designed to try to help affordable housing, shelter sites, project turnkey locations, and navigators. And Karen, thanks for pulling the bill up here. So the bill does several different things. What this rulemaking is focused on is only one element of the bill. There is a new program resulting from the bill. It's a premium assistance program for the types of entities I mentioned previously. We received one-time funding of just under $2.5 million. And this funding is intended for recipients that are in the affordable housing, shelter space, or project turnkey site, or navigators. And it's designed specifically to help with paying down a portion of their property insurance premiums and or liability insurance premiums. So it's, as I mentioned, it's a one-time funding. This program has a end date as far as through 2028. I'm pretty sure based on the level of funding and the level of need that's out there, that the funding will be expended long before the program is set to sunset. Some of the big portions around what we're discussing here and what I'd like to get feedback on is because of that broad-based need, perceived need that's out there, we're going to have to do some kind of capping the assistance, as far as that we want to make sure that we can help as many entities as possible as best we can. But I recognize that that's probably just not going to be helping with the full need that's out there. Another piece that I would like to try to get feedback on, and we discussed at some length in the first RAC meeting, was the application process, the type of information that we think is reasonable to gather from applicants to establish that need, to establish their bona fides that they are in fact providing affordable housing or shelter services or sites, things of that nature. And then also, as far as how are these entities, how can we verify that they are eligible entities? Some suggestions or thoughts around that would be welcome. We've had a few discussions as far as with some of the staff at HCS around like how they know and who they know as far as affordable housing providers and shelter sites. And then a little bit of discussion around how we see payment structures being created, how we're going to prioritize payments being made, because unfortunately with this process, I foresee that there's probably going to be what I'm referring to as winners and losers. It's never a good place to be, where your rulemaking is probably going to create those circumstances. So I want to try to minimize the negative impact of the rules. If where possible, I want to try to make aid available to as many eligible entities as we possibly can, while recognizing that if we just give $10 to every entity, that's probably not doing much of anything as far as moving the needle. And then kind of lastly, as far as how do we determine if this program is successful? What kind of quantifiable metrics can we find to say, hey, this is working. Hey, this effectively moved as much money as we could into the hands of those that need it most. So I think with that, Karen, if you wouldn't mind bringing up the draft language that I had out, the draft document, I think, and I fully recognize that, you know, it can be a little tedious to kind of run through something like this, but I do want to just kind of read through it kind of as a group, and as we kind of just have it up, just kind of just discuss this a little bit. So I think I already pretty much hit most of the purpose and scope of what is being done with this rulemaking. But again, it's providing financial assistance to these eligible entities. It is going to function basically as a rebate program. Eligible entities will have to purchase property insurance and or liability insurance and have already paid for that premium in order to be eligible, is one of the eligibility criteria to receive this assistance. So we can't send money out in advance. This is going to be, like I said, more of a rebate after that insurance cost has been paid, trying to reimburse some of that cost back to an eligible entity. So we just have a few basic definitions here, and again, kind of already touched on it. The only reason I had the definition for Housing Community Services here, since it's a partner agency but not affiliated with DFR, this would be rulemaking within DFR and insurance scope, so it would be a different segment of rule than where OHCS has their rules housed. So I just wanted to have that definition here. Maybe as a good point to pause, is there anything that folks think should be here as far as a definition or language that would be helpful for folks where insurance is not their forte? It's maybe not something they're thinking a lot about that would be helpful for folks. Again, it's not something you have to answer here, but if you want to think about it, give it some thoughts, and maybe submit comments around whether or not other language needs to be included in the definitions. I kept it fairly sparse here, kind of again soliciting feedback, but also we're leaning fairly heavily on what's in statute as far as from that Senate Bill 829. So I try not to double up too much as far as on language that already exists in the insurance code. So sometimes I talk without taking a breath. So I'm going to take a moment here and just pause. Does anyone have any questions or things they would like to add at this point? And we have a fair number of folks here this morning. So if possible, if you have questions or would like to make comment, if you would use the raise hand feature, please. That way we're not stepping on each other. And or like I said, feel free to make entry into the chat as well. Alrighty. I'm not seeing any hands raised or anything in the comments, so I think we'll go ahead and move forward. Karen, can you scroll to the next portion as far as the program structure? Great, thank you. So we already covered most of that first segment, so I don't think we'll double up on it. What I want to kind of start to touch on is that subsection 2. DFR is proposing an initial 60-day application window for this program. Reason why we're looking at doing that is, as I mentioned before, we're anticipating greater need than has been allocated for funding. What I didn't want to see happen is have it being kind of like a feeding frenzy or a free-for-all as far as whoever gets the application in first or second is the one that's receiving funds. It's DFR's intent, along with the application criteria, is to do kind of a ranked or scoring as far as financial need, and basically trying to earmark on a certain set criteria as far as amongst eligible applicants who will receive funding. I did see someone raise their hand. I'm sorry. Was it Natalie? Go ahead.
Yes, I have some feedback on that. I probably just a few of my clients alone could use up much of this general fund allocation. So I agree that the fund is very likely to be oversubscribed, and I think this approach of having an application window and then reviewing all applications simultaneously is the best way to mitigate that. And something to consider is that depending on when which previously paid insurance premiums are eligible and how that lines up with when the 60-day application window hits could potentially exclude some housing providers simply based on when they so happen to renew their insurance policies. So let's say, I don't think that this is something that's addressed in the rules just yet, but let's say that the application window is, I don't know, January and February 2026. And the rules say that the fund will allocate assistance payments to housing providers for their 2026 and 2027 insurance policies. Well, if you're still on your 2025 to 2026 insurance policy, then you're kind of out of luck. So again, I don't think the timing of which insurance premiums will be eligible has been addressed yet, but that's something to think about. So one way to address that would simply be to make policy premiums from the previous year eligible, or perhaps to allocate the general fund in 2 different rounds. Yeah, so because basically different organizations will, and different properties within their portfolios could have insurance policies terminating or starting at virtually any time of the year.
Great. And Natalie, thank you very much for sharing. Those are very good points to make. I appreciate you sharing that. And then Ed, I see your hand up. Go ahead.
Yeah, I agree with Natalie. One of the things I think there's been some discussion about whether the payments should be made simply in the form of partial reimbursements to the eligible entities, as opposed to payments directly to the insurers. So as long as we define the premiums which are eligible for reimbursement as payments that have been made within the described period, that should resolve it. And the other comment, I think Natalie's right on the business. This 2.47 million is going to be a drop in the bucket in terms of what the total need is. And I think our biggest challenge is going to be to establish priorities in terms of how are you going to decide where the need lies most. Is it the number of people? Is it spread across some geographical areas? And probably the ones that are in most danger of closing if they don't get the reimbursement. Those kinds of things are going to be the toughest challenge I think this group has.
Great. Excellent comments. Thanks, Ed. Thanks for sharing that. I appreciate it. Was there anyone else as far as on the call this morning that wanted to respond either to Natalie or Ed's points here, or maybe expand upon them? Great. Great. I'm also kind of an old school note taker. So if anyone sees my head kind of down at an angle, that's me looking at my notepad. So, and we are also, as I think Karen mentioned earlier, we are recording today's meeting as well, just to make sure that I'm capturing and we have an accurate record of today's discussion. So I appreciate that. And I think to Natalie's point, just to share here, and right now the division here has not finalized language as far as we want to make sure we had at least, like I said, a framework out for folks to discuss and get feedback. After today's RAC meeting, I believe there's going to be like an 8 or 9 day window for public comments. It's actually in the agenda, and I'll just scroll to make sure I keep the dates consistent. Anyone that would like to make written comments based on today's RAC meeting has through the end of October 3rd to make comments. Anyone that's sharing ideas or thoughts today, I do highly encourage you to also submit those in written form as well. I do a pretty good job of taking notes, and like I said, Karen is recording, but having that kind of on the record, as it were, really helps as far as we do discussion and internal dialogue as far as how we're going to shape the final rule language. And to Natalie's point too, as far as that is an area that I don't believe is addressed in the draft language here, but I think is very on point as far as concerns around any of the entities that where they stand in their renewal time frame. I know a lot of entities will renew on an annual basis. I think some entities maybe are renewing on semi-annual or possibly even quarterly. And I do want to make sure that we are taking that into account. The bill in Senate Bill 829 was silent on anything like that. So we have purview within the rule language to, I think, make those determinations. So I think those are points well made. And then to add your comment and concern too, I know we kind of discussed or had questions around who should be receiving these payments. And I think after the first RAC meeting and internal dialogue here at DFR, we agree as far as that there is the likelihood is highest that we will be making these as reimbursement payments to the eligible entities. Trying to work out the logistics of paying to an insurer or a representing broker, and then having that money either come back, as far as a policy discount or back to the insured, that would be just a very convoluted and complex process. So I think we can cut through some of the complexity to make sure that reimbursement is made to the eligible entity directly. So I think that's the route that we're leaning, and I think that gives us the least complication and easiest means of getting that money back to the people who are paying it. And then also one of the areas we have discussed here, and I don't honestly remember if I have it in the draft language here or not, it may be further down, but since we're discussing it here now, there was some initial discussion about possibly bifurcating that $2.5 million as far as into distinct buckets for the different needs. So affordable housing would have maybe its own dedicated bucket, maybe shelters would have their own dedicated bucket, and so on. But that those buckets wouldn't necessarily be fixed. Maybe have those buckets for like the initial payment window, and if it turns out that, hey, there is maybe too much money for some reason allocated to project turnkey sites or navigators, and there's much greater need as far as affordable housing, after some kind of interim payment window or period of time, we could reassess and kind of tap those buckets for other areas. Natalie, go ahead.
Thank you. The challenge that comes to mind in creating allocations for the different eligible housing types is that are at all sort of grounded in data, is that the state does not have data on the preservation need across the state. It actually, SB 51 established that in the just ended legislative session, the mandate for OHCS, Oregon Housing and Community Services, to study that problem. And OHCS has expressed repeatedly that they do not have that data. And of course, not all shelters and navigation centers are OHCS funded, so would not necessarily fall under the current purview of OHCS for understanding the need. Obviously, we know that there's a great financial need for all different types of housing providers across the state, and probably any single one of them could use this entire general fund allocation. So it's just challenging, I think, to make any sort of set-asides for the 4 different types of eligible entities that are grounded in any sort of data, because that data does not exist.
Oops, I might mute myself. Natalie, thank you for sharing that information. I appreciate it. And I don't want to take myself too far out of order as far as what we're discussing here today, but you raised such a good point that I kind of want to keep the vein going for just a bit if we could. That's one of the challenges that we here at DFR have also been discussing at some length, as far as we're knowledgeable regulators of insurance and banks and credit unions and what have you. We are not experts on housing at all. One of the areas we've been looking at as far as this application process is multifold. One of the big ones is, how do we establish someone applying for funds are in fact an affordable housing entity? And that sounds like it will be even more difficult to establish that if not all entities are regulated by, say, OHCS. So that's some areas where if you or others on the call have insights on how we can establish, the bona fides of applicants, that is a big question that we're facing here at DFR. And frankly, I don't know that we have that fully baked as far as a good solution that can be repeated across all the different types of housing needs and types of housing. One of the other things too, as far as, and I think a couple of folks have mentioned, as far as around the criteria of making payments or providing assistance on the basis of the financial need, especially like trying to get need to those as far as who may be in the most precarious financial situation. One of the kind of limitations we face a little bit is, in order to establish something like that, we're starting to get into some fairly in-depth financial information that would need to be provided. Some kind of like financial statements, some kind of like statements of cash flow, what kind of debts, what kind of liabilities are entities carrying, and how do we establish that as far as in an application process that's relatively straightforward, and that we're getting kind of apples data from one applicant to the next. And Natalie, well, please go ahead.
Thanks. I don't mean to make this the Natalie show. But to speak to those questions, so the first question on how do you establish a process that can be used across the 4 different types of eligible entities, I don't know that you can. In the case of regulated affordable housing and project turnkey, it should be quite easy. There should be a document recorded against the title of the property showing that there are deed restrictions. And the same will be true for some shelter locations, or they could have, if not deed restrictions, then active regulatory agreements, grant agreements. Navigation centers are the ones that I am the least familiar with, because they don't provide housing, and I work in affordable housing. And I think that could also be a challenging category to verify financial need in the same way that you would do so for, say, a project turnkey site or regulated affordable housing, because typically those properties would be owned by what's called a single asset entity, and there will be financial statements issued for that specific single asset entity, and you will be able to see the assets and liabilities of that specific property and isolate its performance from the rest of the nonprofit or ownership organization. Whereas a navigation center, most nonprofits are not producing financial statements that show the cost breakdown, and definitely not assets and liabilities of program sites. So say you have a nonprofit that runs 3 day centers in different parts of the metro area. It's unlikely that nonprofit would issue 3 different sets of financial statements for each day center, as well as a set of consolidated financial statements. It's probably only issuing consolidated financial statements, and it might have some information on operating expenses associated with different sites, but it's very unlikely to have a full set of financial statements for each site that show assets and liabilities and isolated financial performance. So again, like you're saying, there's not exactly comparability there. There's going to be more comparability between regulated affordable housing, project turnkey, and some shelter sites. And then you kind of have 2 different models of financial management really that could be coming up. One is like a programmatic model with consolidated financial statements, and then another is site-based with single asset entity financial statements.
That's excellent insight, Natalie. Thank you for sharing that. I really appreciate it. And then Ed, I see your hand up. Go ahead.
Yeah, I think one of the issues here, and Natalie hit on it, is that we're not going to come near solving the problem, and insurance is only one of the cost issues that are driving the issues for these things. When it comes to affordable housing, and I think it's true of probably the other shelters as well, my sister is a vice president with Collier in Portland and focuses on multifamily housing and does a fair amount of work with clients who are developing or operating affordable housing projects. And she forwarded me some information from California, for example, where what they're finding is that as these projects reach the end of their lifespan of the agreement, where they are no longer subject to the rent limitations, they're basically dropping out of the affordable housing market and just going into the market rate world because they can, and they can't afford to continue to operate in a world where they can't raise their rents, but everything else can go up and they have no way to recoup it. So that's, I think, one of the biggest challenges for this group would be to say, how can we identify those properties? And they're probably going to be the older properties that have the most insurance problems in terms of either getting it or affording it. And they're also the ones that are more at risk of basically either going out of business or just basically converting into the market rate environment instead of affordable housing. So I don't know how we can do it, but if there's any way we could identify where we can make the biggest difference is to keep these businesses from going under or going out.
No, that is an excellent point. And Natalie, did you want to respond to Ed's comments there?
Yeah, I think I can provide some background information on this that will be helpful. So Ed is absolutely correct that there are properties that are or have been recently regulated affordable housing and the use restrictions have expired. And use restrictions can be anywhere from 30 to 99 years. And so the chances are the properties that have expiring use restrictions were placed in service somewhere between 30 and 60 years ago. And so, yes, they tend to be older. And some owners, typically for profit motivated owners, are converting those properties to market rate. Not all of them are, though. Not all profit motivated owners are doing that. And certainly nonprofit owners generally would prefer to maintain their properties as affordable housing. And then there is another set of properties that are at risk of foreclosure. And it's these two things can coexist. They're not mutually exclusive. They're, in terms of the Venn diagram, it's not a circle. There's some crossover between properties that are financially distressed and properties that are have expiring use restrictions. But there are lots and lots of properties that have use restrictions on them for many, many years that are at risk of foreclosure. And the problem with that for the state and on a policy level is that typically, if a regulated affordable housing property goes through the foreclosure process, which I will say is exceedingly rare, but is probably going to happen more often in this economy and with the amount of preservation resources, the paltry amount that the legislature allocated in the most current legislative session. I have to back up a little bit here. So the problem on a policy level with properties going through the foreclosure process is that typically affordability restrictions will be lifted. And so the state has a vested interest in helping prevent foreclosure of regulated affordable housing. So my recommendation would be to prioritize currently regulated affordable housing that's not necessarily at risk of use restrictions expiring, rather than prioritizing properties that have already had their use restrictions expire. It's a hard choice because obviously if you lower costs, then that is encouragement for an owner to retain a property as affordable housing rather than operating it as market rate housing after use restrictions have expired. But in a world where we have to make hard choices, the one that I would recommend would be prioritizing properties at risk of foreclosure in order to maintain the current affordable housing stock, rather than hope that a small amount of assistance would encourage a profit-motivated property owner to retain their property with expiring use restrictions as affordable housing. Does that make sense?
I think that makes a lot of good sense. I do have a follow-up question for you, but I see Ed's hand up. So Ed, if you want to go ahead and add your thoughts.
Yeah, I agree. I think one of the biggest challenges will be the last thing we want is to send a reimbursement check to somebody and then have them go out of business anyway.
Oh, I agree. And so kind of in that vein, and I hear what both of you are saying. So, and that's been a concern that we've kind of mulling over here at DFR as well. And Natalie, kind of to a degree, I heard you kind of almost making kind of a recommendation. It seemed like on both sides as far as trying to help those properties or those providers of affordable housing. They're kind of at the cusp as far as it could break either way, that they're financially distressed, but assistance may make the difference of them, effectively staying in business and maintaining the inventory. But I think the way Ed phrased it there is really important. It's that is kind of a pretty difficult metric from a financial perspective, as far as how much distress is an entity actually facing, as far as is it acute, is it midterm, is it long term, and the way Ed phrased it is very much a concern as far as, especially with such a limited funding pool. What I would hate to see happen is, commit funding to an entity in the hopes that we're going to preserve housing, and in the hopes that it makes enough of a difference that they don't have to go through bankruptcy, or that we don't lose affordable housing stock. But if it turns out not to be enough, or they face additional financial headwinds and they do go through bankruptcy, or that property is lost, that's potentially financial assistance that could have gone to a more viable entity. And so we've had, like I said, a lot of discussion around how close to the edge should an entity be, and that's a hard one to ask. I mean, from one sense, I could see it like, well, hey, they're on the edge. That's almost maybe demonstrating the greatest need. Like if they don't get it, maybe they stop being an affordable housing provider, and so many units of housing are lost. But also in being good stewards of taxpayer money, how do we know that the assistance isn't just going to go into the bankruptcy process and not to maintaining that stock? And quite frankly, it's kind of unknowable. But I did see you drop some information in the chat. I'll take a look at there in just a sec.
Just adding that historically foreclosure rates on LIHTC, low-income housing tax credit properties, are very, very low. So which is not to say that it's not a valid concern, just that it's extremely infrequent.
No, that's very helpful to know. I appreciate you sharing that information. One of the other things too, and I don't want to belabor this too much, because I know we have some other areas of the document here still to discuss. And actually, maybe what I'll do here, just in the interest of time, because this has been a good discussion, it's been very informative. I know everyone's busy and they have many demands on their time, but if at all possible, as you're giving some thought to this and as we have dialogue, if you would please, if you could take that time to submit some of this as far as in the public comment period, it would be much appreciated, and I think would be very informative in this rulemaking. I think we're going to go ahead and move on to a little bit more of the language. Karen, can you scroll us forward a little bit? Alrighty, that would be great. Alrighty, so this is kind of around eligibility. I think we have kind of a good grasp. The bill spells out as far as entities that that will be eligible to receive this premium assistance. When we kind of discussed a little bit as far as how do we know that something that says they're affordable housing is affordable housing. It sounds like entities that are regulated, it'll be a little bit easier to establish, but I would love to get feedback from the group at large. What are telltale signs, or what are things that we could ask in an application that would be comparable from one applicant to a next, saying, yep, they are definitely affordable housing, or yep, they are definitely a viable or above board shelter location. And I see Natalie was sharing some information in chat here. And Natalie, just want to double check. So are you asking then, as far as kind of what's the point of asking if someone is a nonprofit, or what is the point of asking if they're eligible?
Yes, if it's not a requirement to be a nonprofit to be eligible, then seems like it's not a useful piece of information in terms of making the application simple. Now, I would not be at all opposed to prioritizing nonprofits in the application process. I think that would be a great idea, because nonprofits tend to put more of their revenues back into the local economy than for-profit entities. But as it stands, for-profits are eligible, and there are many regulated affordable housing properties that are owned by for-profit entities. So if it's not a requirement, then it seems superfluous.
No, I appreciate that, and I better grasp now how you did that, as far as there was that sub 6. I had to read a little bit further what your comment was, and that is one of the areas that we've kind of been discussing here as well, as far as, and we've also taken from a slightly different stance too, as far as the reason why we were thinking that making the distinction between for-profit and nonprofit would be important, especially in kind of determining who might get assistance or how much assistance is rendered. Nonprofits have a very limited means of raising capital, whereas for-profit entities have, I think, a broader range of opportunities to raise capital. Depending upon how they're structured, they can do anything from sell shares, they can issue bonds. Just it kind of depends on how large and how sophisticated they are. Whereas nonprofits, really, outside of donation, government support, or if it's a government funded program, much more restricted on the ability to raise capital. So that was one of the reasons and one of the thoughts we had kind of around that. And Ed, I see you had your hand up. Go ahead.
Yeah, I agree with Natalie that eligibility should not necessarily be the issue for nonprofit versus for-profit. But prioritizing might make some sense, because of the fact that the not-for-profit are more likely to be driven by altruistic motives. I would take issue with the statement that not-for-profits necessarily deliver more back into the communities. Having been involved in both for a long time, for-profit entities are the first ones that people turn to for donations on civil events and job creation. So I agree with that point, but let's not demonize the for-profits as somehow being more, less contributing to the community.
All right, thank you, everyone. I appreciate the feedback. And Natalie, I understand having tech issues. I totally get that. Just also checking here, we had some other folks in comments, and for folks who maybe happen to be on the phone, I'll just share some of what's here, just kind of in summary. So Natalie had mentioned, as far as also maybe requesting grant agreements or declaration of land use restrictive covenants, regulatory agreements, or deed of trust, as possibly establishing kind of the bona fides of applicants. And then Brian Hoop had mentioned he agreed as far as that with Natalie, as far as maybe nonprofits should be prioritized as far as in kind of the hierarchy of receiving payments. And then let's see. I did show a question. So are shelter locations eligible? There's a broad range of models like day center, motel vouchers, seasonal severe weather, alternative shelters, housing focus, and et cetera. Yes, as far as shelters are eligible, as far as they're one of the eligible entities. To be perfectly frank, as far as I know, even less about shelter entities than I do about affordable housing, and I would say I know relatively little about affordable housing. And Danielle, did you have a moment? Did you want to share or provide maybe a little more of a shelter perspective? I don't think we've had much of that in the conversation yet.
Yeah, thank you. I'm not sure I have a recommendation at this point, but I think it's a question that's going to come up, particularly if there's going to be alternative type shelter models, if that'll be eligible. So there's a lot of new models that use things like Conestoga huts where they may not meet shelter habitability standards. And so maybe this program wants to focus on one or the other, but I think it might be a good idea to spell out what shelter means.
And one of those areas that we always kind of run into when there's kind of multiple areas of expertise from one agency to another, and maybe other folks from HCS can answer this too. Does HCS either in rule or bulletin or statute, is there a good area as far as an existing rule or statutory language that defines shelter? What I don't want to do is either kind of recreate the wheel or try to define shelter in error.
Yeah, I can provide some more information after this meeting. We're actually in the rulemaking process right now of defining shelter for the statewide shelter program. And so those won't be adopted until late December, early January, but I can follow up with you.
That would be excellent, because where possible, where entities have already kind of established that bright line of a definition, we want to try to lean into that. Again, we're working from the insurance perspective here at DFR. That is definitely our bailiwick. So we want to make sure that we're trying to keep this consistent and that we aren't trying to do something that's at cross purposes that's being established or is established somewhere else in statute or rule. So yeah, that information would be very valuable to us. All right, Karen, can we scroll to the next segment here? Okay, so prioritization of payments. I think this segment is, I don't want to say it's straightforward. It's not. It's actually where we've had probably the most discussion internally and to a degree externally, as far as how do we make a program that's useful or helpful without, like I said in my earlier example, just giving everybody $20, because we recognize that that's not going to be helpful. And Natalie, I saw that you dropped a question into chat. Go ahead.
Yeah, the question can wait until later. That was related to the last section, but I know that we need to move on, and I'll submit more feedback on that in my written comments. So to speak to the question that you just posed, I thought it would be helpful to kind of lay out the financial situation of a property that I could see applying for this resource. A regulated affordable housing property in the Portland metro area that is at risk of foreclosure. And to provide an example of what 5% of the total paid premium or $20,000 would actually look like for this property. So 75 units, deeply financially troubled, has, let's say, $400,000 in accounts payable, which means unpaid bills to various vendors, say the water bureau, maintenance company, what have you. And an annual insurance premium of $100,000 a year. That, of course, it's struggling to pay because it has $400,000 in unpaid bills. This property is making choices between, do we pay staff or do we pay for utilities? And this, this could be any property in my mind. I have a specific one in mind. But it's not really about this property. So the lesser of 5% of the total premium, assuming that's annual, or $20,000, is about $5,000 because the annual premium is $100,000. HDC's client is not going to spend time applying for that money for this property. It's not going to be a useful exercise. They have way bigger fish to fry. So this is speaking to exactly the issue that you've been pointing out, that balancing, helping as many properties as possible while also making a meaningful difference. And my sense is that the current caps as proposed, and I don't know, how firm these are not enough to make a difference for the kinds of properties that I am seeing from my clients being at risk of foreclosure.
All right. And then, and I see your hand up. I'll get to you in just one sec, just to provide some kind of information around the caps. The caps right here, right now, are kind of in flux. We needed to have some kind of a number just to provide framework and frankly, to have this kind of discussion. So
yeah,
the cap amounts are certainly not set, but rather than just have blanks there, I wanted a number. A number gives more of an emotional response than X's or nothing. So that's kind of where there's still a lot of discussion around that, and frankly, getting this type of feedback is what we were hoping to get. And Ed, I did see your hand up. Why don't you go ahead?
Okay, yeah, my question of Natalie, just out of curiosity, how would your imaginary client respond if the 5% was raised to 20 or 25% and the $20,000 cap stayed there? Would that be enough for them to apply?
it would, and it would also not accomplish the goal, if it is the goal, of saving this property from foreclosure. Another data point that might be useful is that the average per unit per year insurance costs for regulated affordable housing in Oregon is about $700. I would advocate for there not being a cap and paying up to 100% of the premium, or less if the housing provider applicant would like to apply for less to allow the resources to be distributed elsewhere.
Yeah. So maybe a dollar cap, but not a percentage cap.
Or perhaps it would be hard to set a cap that would be meaningful for all the different types of housing, but usually the way OHCS sets its subsidy caps is on a per unit and a per unit basis, and then they usually add some other criteria. So there could be a per unit cap. I mean, I could see why the Bureau would not want to fund insurance premiums that are 3 times the average cost per unit per year, because that would indicate that there is probably opportunity for cost savings. I think the $20,000 cap means that you're not going to save any property from foreclosure unless it's, I don't know, a few units.
Thank
No,
you.
that is excellent discussion. It was a really good question, and I appreciate the honesty in the dialogue here too. Is very helpful. And then Natalie, one question as far as, I mean, it sounds like you're conversant on this and are knowledgeable. So I frankly would just love to get your feedback on this, and anyone else on the call as well. So one of the things that DFR will have to do with this program at some point is we're going to have to establish, not just the financial need, not as, you know, is an entity approaching bankruptcy or are they on solid financial footing? But you raised one of the core points that we look at from an insurance perspective is if you have two example properties, they have roughly the same number of units, whatever that may be, but one property has an insurance cost that's 3 times higher than the other affordable housing provider. There can be a lot of important why behind that 300% increase. Is one entity managing their risks more effectively? Are they doing a better job of maintaining the property? Are they being proactive in managing their risk? One of the things we try to be very careful with in insurance at large is we don't want to incentivize kind of risk-taking behavior. We in insurance are very risk averse. So some of what we're, again, still grappling with is how do we get enough information from an applicant to be able to establish that, well, what may be a pattern of like, why would this entity have such high insurance costs when it seems like a like entity in same geographic area has much lower insurance cost? And that can be a range of issues that are basically unknowable. Is it just they're not aware of another provider that can provide coverage at a lower cost? Maybe not. What is their risk management techniques? How proactive are they being in risk management? That insurers have whole underwriting departments to establish that. And so a criteria for some kind of like an assistance program, how we ask those questions and ask for them to demonstrate, how they're managing risks is very difficult kind of within a kind of an application process. And I'll be perfectly frank, DFR is not like a public assistance agency. We're not super public facing as far as in providing grants or awards to the public. So we're trying to find criteria that we think can be have high uptake, be effective, be relatively low administrative burden on both applying entities and then us as folks trying to make those awards. So this is really important feedback to be getting, and I appreciate everyone sharing their frank opinions and their knowledge on this. And I see also too, as far as quite a few folks have dropping information into the chat, enough for me maybe to have a hard time summarizing here. One of the areas that we've looked at, and it's kind of one of the last things I saw kind of in comments here as far as around cost of insurance or COI and loss runs. Some of what we've been looking at as far as part of the application process is how do we ask for information from an applicant that they can gain relatively easily and hopefully with low or no cost or time spent. So we've been looking at things as far as asking for things like declaration or binders as far as the insurance coverage, because that's another big piece too. You may have an entity that's insured for much higher covered losses. They may have lower deductibles. They may have higher headline coverages as far as on a per occurrence or per location basis. So that's part of what we need to kind of have as far as a comparison. If someone has basically platinum coverage and someone has like dented rusted metal coverage, as far as that can be a business decision as far as where entities are maybe making those selections. And Natalie, go ahead.
Yeah, that's that point about the different levels of coverage and the costs associated with those is why I suggest, one solution being, okay, we set a benchmark, and anyone that's applying for assistance above that benchmark gets a higher level of review. If your cost is in line with the typical cost that we're seeing in the Oregon market, and you're regulated affordable housing, you're a shelter, then you could be kind of good to go.
This is Melissa.
And
hey, Bonnie, how are you?
it seems like someone is having different
I have a meeting,
conversation.
but I have a couple questions about this.
There we go. There are also reasons that properties that are in distress might have that, as you say, platinum level coverage. There, say, are housing authorities that have significant financial resources, terrible loss runs, and have also significant control over their properties, and have increased their deductibles to $150,000 a year. But your neighborhood nonprofit cannot do that because they don't have the same level of control, and they do not have access to $150,000 should there actually be a loss at one of their properties. So they might make the choice at a financially troubled property to have that platinum level coverage because they have no risk tolerance. So there could be a sort of individual level review for applicants that whose cost sort of exceeds whatever benchmark you decide to set.
No, that is very helpful feedback. I appreciate that. One of the things I want to make sure I'm doing too is I want to be mindful of time. I think I've actually run a little bit long as far as on some of the discussion of the draft language, and my apologies for not getting all the way through it, but it's actually the sign of a good discussion. And I also really appreciate folks making comment as far as in the chat here. That's very beneficial for myself as well to mull some of these points over after the discussion here. Hey, Karen, just real quick, can you scroll forward just a little bit? I kind of want to see how much we have left here. So kind of application process, you know, impossible metrics. Okay. All right, so we got through a fair amount of stuff here today, so that's good. What I want to do here, without unfortunately rushing through this, because it's an area I still would like to get feedback on, but folks here should have copies of the draft language. So maybe during the public comment period here in just a second, if folks want to kind of speak to some elements there that haven't already been discussed. But what I want to make sure we do here is, if there's anyone on the call here today that is not formally a member of the RAC, is an interested party and would like to make comment either on anything that's been discussed so far or anything as far as in the draft language itself, as far as we've not yet covered, this is the time of the meeting today I would like to set aside for folks that would like to make that comment. Would like to bring any other points that maybe were not addressed in the agenda or not in the draft language framework that you feel is important for either myself or other members of the RAC to know about. So I'll kind of pause myself here talking. I'll open the mic up to anyone that's interested in sharing thoughts, opinions, feelings on this. So double checking the chat to see, make sure I'm not missing anything there. Okay, I'm not seeing or hearing anything. So this is just kind of a station identifier to participants. Since we haven't had anyone note as far as wanting to make public comments, if it's all right with everyone, I think we can go ahead and continue the discussion. Just recognizing that if someone does want to raise a point from the public and they want to raise either questions or add to the record, that we'll pause discussion to make sure we allow for that. Hey, Karen, can we go ahead and thank you very much. Can we scroll down a little bit to the application process? And some of this is a little bit duplicative of what we discussed. So as I mentioned earlier, as far as it would be our preference, or we think it'd be a good idea to have an initial application window. Again, the numbers here were arbitrarily selected. We're not married to a number. What I would like to try to do is have an application window that's useful, that gives, like I said, a period of time for kind of all comers to make an application and for staff to review, that is not simply just a first come, first serve. And then also, sorry, I was reading a chat message here that was just dropped in. And Brian, yes, I'll make sure we can do that. One of the things, so just getting feedback as far as is 60 days seem like a reasonable amount of time? Is that too long a window? Obviously, we're trying to find folks that have a financial need. Just having, what I don't want to have is an overly long initial window that someone who, would be eligible is likely to receive payment, but they've got to wait for that window to close, and then for DFR staff to run through the review process. open to suggestions. If 60 days doesn't seem like it's overly or unduly long, we're happy to keep that. All right, not seeing too many slings and arrows coming from participants, so that's always a good sign. So it'll probably be in all likelihood, 60-day, unless we have additional internal deliberation. If we change it, though, I can't see it going longer. If anything, it would go to a shorter window, but we don't have full and final decision on that. But it sounds like we're not hearing a lot of opposition to that. But also, too, as far as especially around application process and anything listed here, if you're planning to submit public comment or written comments, please feel free to address these items as you see them. If you have areas where you think the language can be improved, if you want to provide example or preferred language, we are happy to review that. And then also, I should have done this at the very beginning, and my apologies for not doing that. For anyone who is new to the RAC process, the way RAC works is we here at DFR are soliciting input and knowledge from folks who frankly probably know quite a bit more about things like shelters or affordable housing, project turnkey, what those needs are than we do. It's an opportunity for us as regulators to be educated and hopefully to inform us as far as we write these rules to be more accurate, more incisive, and hopefully more useful. But that being said, with the RAC process, this is an opportunity to advise. But anything as far as discussed here today, it's not binding on the agency or the insurance commissioner. Really, as far as like I said, we're gonna try to write the best rules that we possibly can, but also want to try to make sure I'm managing expectations, especially if someone is new to the RAC process or has not participated in the RAC before. So again, my apologies and that oversight for not doing that earlier in the process. Let's see here. Karen, let's go ahead and scroll down to the next little bit. And so kind of what we're looking at here. So, and I don't know if we spelled it out clearly enough here. Hopefully we have. As far as, so after that 60-day window, as far as applications are coming in, what we're hoping to do is write or create an application that's incisive enough for us to create basically like a scoreable application. The different elements that we can collect in the application as far as will allow us to be able to tier or rank need, especially things around like financial need, what types of an entity is like providing coverage. I think someone had dropped in the chat earlier as far as around culturally sensitive as far as populations. The geographic region could also be at play. Some of the areas that we've also had some concerns I want to make sure we're addressing is maybe units of housing that are at risk, as far as if an entity can be helped, how many housing units can be preserved, as far as, because at the end of the day, in our direction from this bill is that we're trying to maintain or provide the maximum amount of assistance to help preserve as much housing stock as possible. Or for any entities that are getting into providing affordable housing, just that extra little bit of an incentive as far as, do they make that determination, like I'm going to go affordable housing, or do I go kind of for profits just into the market-based rates? I recognize with the funding at hand that it's going to be unlikely that we'll incentivize anyone that's looking to go into the market-based rates. This probably won't be enough of an incentive to sway them, but we don't want it to be a deterrent. Is there any documentation folks think that entities could provide, that most all entities could provide on kind of a like basis? I know we've had some discussions around financial need, but then again, also some discussions around like smaller entities probably won't have the financial reporting capabilities as large multi-location or large, like maybe even multi-state entities that provide affordable housing. So if you have thoughts or suggestions around what can be asked for that we could expect every applicant to be able to provide, that would be helpful. One of the other things I think would be also useful, we're looking at asking for not just the most recent insurance binder, but for at least 1 year prior. We're trying to see if we can get some comparability, things that would allow us to ask questions or hopefully get at some of the heart of what I was saying as far as, is someone maybe trying to acquire platinum level coverage where others are just getting, rusty metal coverage, as far as how we can discern that. And then also part of what we were looking at doing at the end of this, as far as, since a lot of these entities may not even file or be on the radar with HCS as far as being a regulated affordable housing entity, that really puts us kind of at a disadvantage as an entity trying to get, tax money out to entities to make sure that they're above board and to make sure that we're meeting the need and the requirements of the bill. How do we go about doing that? How do we prevent this from becoming something that is fraudulently tapped into by bad actors? I'm open to suggestions. Like I said, a lot of the information that's here as far as was around discussion points. If any of these language items would be more useful than others, it'd be nice to know that. If there's any areas that we think would be a high pain point for many or most entities, that would be good for us to know as well. And again, I know we kind of raised this earlier as far as, is it worthwhile making a distinction between for-profit and nonprofit entities? Again, I asked that to the group at large as far as, I think between what a for-profit and nonprofit has as far as resources to make this application would be also of a concern to division staff, as far as recognizing that there are many nonprofit entities that are trying to maximize the amount of money that they're putting into whatever kind of social resource they're trying to provide. They try to minimize overhead as much as possible. And many for-profit entities do that as well. So what I don't want to do is create any kind of competitive disadvantage between for-profit and nonprofit. And Karen, was there another page or was this the last page?
I think there's one more.
Okay, I'm pretty
Here we
sure
go.
there's two. Okay. So, and then kind of lastly, as far as that sub H there, as far as for one of the things we are a little constrained by here, because again, we're a designated regulator for financial institutions. This puts us into an area where, frankly, we're not entirely sure 100% what our legal authority would be as far as to how to ascertain or how to legally ask for some of the information we might be asking for in this application process. So one of the things we wanted to make sure and have something along this line, doesn't have to be this language necessarily, but some kind of legal attestation that whoever's making this application is making true and correct statements. That if someone is making false statements, because this is public money, this is taxpayer money, that there is the possibility of legal repercussions if someone's making false, misleading statements with this application. And then I did see a comment coming in here real quick as far as from Ed, as far as on the impacts. Ed, that's a great question. And I do think that probably needs some further development around that, because I know even in today's discussion, it's been largely centered on affordable housing. I know we've had some discussion too around shelter sites and shelter locations. Anyone having insights or thoughts on that, I would welcome those comments during the public comment period. Again, I'll give another plug to that. Public comments will be open and accepted through October 3rd. I would very much encourage folks to make written comments for staff here to review. And then I think Brian Hoop is making a good point there too, as far as that as a legal entity, I do think they would have to be registered with Secretary of State in some fashion. As far as some kind of a legal entity, I think they'd have to be recorded somewhere with Secretary of State. Right. And then I saw it had same question for shelter beds too. Alrighty. And I think more than anything else, as far as the language around program metrics, if folks wanted to kind of opine on that, as far as anything that's there, if there's anything that they think would also be a useful metric, would be helpful. We were and are directed by the requirements of Senate Bill 829 that we will have an annual reporting function to the legislature, and one of that is how well is this program performing as far as how well did it move the needle, and how can we show that we were good stewards of taxpayer money for the intent of the bill. And I think with that, that's probably a good spot for me to pause. And Natalie, I saw you just jump back on. I don't know, did you have some tech issues there?
Yes, unfortunately, my
Okay.
Teams app is not behaving.
No, my apologies. I'm not sure where you may have dropped off as far as where I was kind of monologuing there for just a minute. So really just encouraging folks as far as during the public comment window that's open through October 3rd. I would ask that you just go ahead and review the draft language here. Anywhere that you have suggestions or think the language can be improved, or if you're seeing areas where just frankly it may not be of enough use to include, please feel free to communicate that. And then Brian, I see your hand up. Go ahead. And Brian, my apologies. If you're talking, I can't hear you. All right, it looks like still some microphone issues with Brian. I understand. Peter, I see your hand up. Go ahead.
Yeah, I'm curious. Do we if this is an emergency response situation? I think structuring a program could look one way. If there's thought that this is a platform to become a permanent program, then that would include kind of a different way of thinking. Is there any way to signal? Is this truly just a 2-year, couple $1 million because we're viewed as crisis moment? Or are we trying to build a system that could run for decades?
No, that's an excellent question. So how we're looking at this right now is just by kind of letter of the law as far as what's in the bill. So the bill itself does have a definitive sunset date. It's December 31st of 2028. So any monies that have been appropriated to this that are unspent, I do believe returns to the legislature. So in that regard, this is defined as a finite program slated to end in 2028.
Okay, great. I would just say that I totally understand the need for preventing fraudulent use. The encouraging risky behavior, I would be less the nonprofits right now, they are struggling with the reality, somewhat similar to what Natalie was sharing, of 2 years ago they had insurance premiums of $20,000 for their property, and now it's $80,000. It's those types of shocks that are really being felt right now for the nonprofit, and I'm guessing the for-profit but affordable housing providers. So it has a lot less to do with oh, they're a riskier actor, and more the reality of the environment, the reduction of players in the market, the reinsurance costs skyrocketing, the reality of if you have a 5-story building and someone on the 5th floor causes a flood, it takes out 20 units. But we're here to house members of our community. We're just dealing with the economic reality of some of those risk profiles. So I would just caution us to not get too over revved on the bad actor kind of persona. It's like people who are working their asses off, and they are struggling right now to pay these bills.
All right. No, I appreciate you sharing that insight, Peter. That's good to make sure that we continue to kind of ground the discussion as far as this is an immediate need as far as there are entities that are hurting. We've seen it as far as on the regulatory side, as far as how much premiums are increasing across the board. That's anything from individual homeowners to commercial insurance for entities outside the housing sphere. But the need that's been identified here with affordable housing, there's so many different implications there, and quite frankly, many of those implications are very far and wide ranging. Anything from just the sheer run up in price of housing, as far as in even just the last couple of years, how much it costs to replace or repair damaged buildings has skyrocketed as well. for years now, plural, we've been seeing, as far as not just in the Pacific Northwest, but across the nation, insurance premiums increasing by double-digit percentages year after year. And as this is being studied, as this is being looked at, as far as, hey, is this price gouging? Is this profiteering? As it's coming back, there is just more frequent and more expensive claims being filed year over year. And so and one of the reasons why I was kind of harping a little bit as far as our entities managing their risk profiles is there has been a meaningful difference as far as in entities that really, and this is anything, this is homeowners, this is communities, this is commercial structures, that those that are actively making an effort to manage their risk versus like, well, I provide housing, but I don't really pay attention to anything else. There's been a meaningful notice as far as, and in the data, as far as how much less they can reduce their risk. Not to say that it eliminates it, but it can be reduced. So those are things that we're seeing. And again, that's broad-based and far outside just the sphere of affordable housing and shelters that we're discussing here. So I think right now, and I want to make sure that I'm being mindful of everyone's time, because I know we're slated to end here in just a couple minutes. Right now, I don't believe we have another RAC meeting scheduled. I guess maybe something to consider as far as it will depend largely on the feedback that DFR staff receive from folks and interested parties, whether or not there's going to be a third RAC meeting. Right now, we've not scheduled for a third RAC meeting, but if we feel that there's additional discussion that's needed, if we feel that we get a significant amount of feedback as far as from written comment that should be addressed in a RAC format, we'll look to maybe schedule a third one. Right now, that is not currently anticipated. But if we do need to schedule a third one, we'll make sure that everyone that's indicated that's on the call today or has been a part of the process to date, that we'll make sure that we're including everyone as well. So I think with that right now, one last time, I want to thank everyone very much for your time and sharing your thoughts and your frank opinions here. It's much appreciated by myself and DFR staff. And then, of course, one last plug. We have that open written comment period. It's through close of business on October 3rd. And then kind of after that closing time frame, DFR staff will make kind of a deliberation as far as if a third RAC meeting is warranted and needed. If in the event we do not have another RAC meeting, what we're going to start to do then is we will start to circulate draft language as far as for the rule itself. And Karen might have to save me here because I'm not as familiar with the filing process. Once rulemaking is filed, there is a comment period that I believe Secretary of State also has. So if as the language is there, if you feel that there's additional need to make comments, there is another window to do so on the Secretary of State side. So Karen, please feel free to let me know if I'm missing or mischaracterizing anything there.
Nope, you got it. So yeah, basically there'll be 30 days of additional comment period once we file our notice of proposed rulemaking.
So if anyone has any questions, and again, folks who are new to rulemaking, state rulemaking, or the RAC process, please don't hesitate to reach out to myself or Karen. If we don't know the answer, we're more than happy to find that answer for you. But I want to really stress here too, I recognize, especially with the amount of funding we have here, that we're not going to be able to meet all needs everywhere. It's just, that's not possible. The goal of this rulemaking is to try to meet as many needs as possible, to try to stretch these dollars as far as possible and preserve as much affordable housing and shelter space as we possibly can. I know that's an ambitious goal, but we're going to do the very best we can. And hopefully with this type of dialogue, with your comments on the draft rule, we can get to the best possible outcome that we can for as many participants. So again, on behalf of DFR staff, I want to thank everyone very much for your time and your invested efforts in this. It is much appreciated.
Thank you.
Thank you.
Great.
Thanks.
Thank you very much, everyone.